is up, guys? I'm gonna be programming. Let's see. I think project cd. What? There it is. The nvim. That's a BP. We're gonna be starting a new project. Or not new. I've been working on some cryptography stuff recently. And I kind of, I kind of understood it a little bit. I thought it was kind of interesting. So we have this stuff. Uh, yeah, I was just writing the basics of how like a blockchain would work in C++, just for fun. But I have a new idea that I want to try implementing. First, before that, let me see if I am actually streaming. Let's see. Okay, so I am streaming. Cool. I think I can close this. ChatGPT open. That's cool. And then I can close this stuff, I think, for now. We have music playing in the background. Okay, yeah, so I think I can start working on this new idea. So this is a little novel. I need to figure out how to like set this up and stuff. So yeah. So first off, let me just go through the idea. The very basic idea is the main problem I see with traditional cryptocurrency like Bitcoin is that it cannot be used as a medium of exchange. The primary focus of money is I believe unit of account, store of value, medium of exchange. Right now, Bitcoin's treated like an asset. Whatever, Ethereum, whatever. By the way, I have nothing to do with the crypto industry. I don't have like pump coins or whatever. So I have nothing to. I don't own Bitcoin. I don't own anything. I'm just like observing. So it's not like a crypto scam or something. I just like the programming side of it. The main problem with like cryptocurrency right now is that uh, it's used as a store of value, sort of like an asset like gold. I want to see if we can create a cryptocurrency that can essentially be used as a medium of exchange. So let's just say, you want to buy stuff on Amazon. You just, you transact using this currency. What the crypto industry right now is doing is what they call a stable coin, which I think is pretty stupid because a stable coin is basically just a centralized form and it's pegged one to one to fiat currency, which which is which is what I believe is how a stable coin works. You basically have one crypto equivalent for $1 or something, and you have like this centralized agency that makes it that's supposed to, keep your funds or whatever. But like, who knows what they're doing with those funds? It could lead to some FTX type collapse. The whole point of crypto was to make things decentralized, and it seems like we're pushing towards centralization to fix a bunch of our issues. So I wanted to see if you could make something that's cryptocurrency, but essentially can be used, which is essentially stable without being backed by anything. Um, so I want to make it. So this is simple idea is I want to make a cryptocurrency that essentially is price stable but supply volatile. So the supply can change, uh, however, but the way what we essentially want to do is kind of make sure that the price of the currency stays the same over a long period of time, similar to the dollar. Um, so So we go to the dollar index. Right now, dollar is down. I think what is this? Why is this market watch? This kind of looks terrible. So I think let's look at yeah. So I mean, right now it's going down or whatever, but still, it's only 6%. At the end of the day, it's not a huge deal, right? So before that, I want to like, this is gonna be my first stream. I'm actually gonna change the name of the stream to something that reflects what I'm actually trying to do. So before that, I want to like increase the volume of this a little bit. Anyways, yeah. So let's see. How do I change the name of the stream? Do I go to settings? Doesn't seem like it. Start with studio mode. Studio mode? What's this? Program, scene, transition. Nope. Docs. Okay. Yeah, I don't know. Maybe I can change it real quick over here. I don't want to do this on stream. By the way, if you guys can't tell, I suck at streaming. Let's see, edit video. Yeah, I think that works. I'm just gonna say programming dot. You know, that's the name of this currency. Now, I don't know if this is gonna work. Maybe it won't. As you can see, I like the name dot. I mean, right now I'm just bad at naming stuff, so all my content is like named dot. I have dot engine, dot os, and now I have dot for this. But this is partially blocked. Huh? Why is that? How do I see details? Who can't see it? Russia. Yeah, I don't really care. Cool. So how do we do this? The idea is, right, you want to basically so first let's understand what like Canadian economics is to understand why the dollar is like semi-stable. The Fed has a target of 2% interest 2% inflation yearly. The point of Canadian economics essentially is to intervene during downturns and upturns, whatever, to basically control the supply of money in the economy to make sure that people aren't suffering too much. So even if you have runaway inflation or something like that, you want to make sure that the supply of money is ample so that businesses get more money that they can borrow and increase their money supply so that they can maybe hire more people during an unemployment crisis. As a side note, right now we're in a K-shaped economy, so I think the Fed's looking to decrease rates, hoping that hiring will pick up. But we're in a situation where like AI and stuff is like quote unquote replacing jobs. I'm not sure how true that is, but like I don't think we're in a terrible economic cycle right now. And I'm not sure that's the reason why unemployment is bad. So it's going to be interesting to see what the Fed does, because when they decrease interest rates, we're going to get runaway inflation, but we're not, or my prediction is that we're not going to see massive benefit or massive changes in unemployment in the short term at least. So we'll see what happens. Anyways, so that's Canadian economics. So that's that. How does the U.S. keep their dollar stable? So that's an interesting question. So number of things, like the U.S. is a global reserve currency, right? So it's an extremely liquid asset, or not asset. So it's extremely liquid. Many sovereign, so many countries and their banks hold U.S. dollars. A great example would be Japan. And the huge, Japan is like going through this yen carry trade or whatever. They have their own issues with the government. The reason why their government or their country is not collapsing economically is because they have, I think, the highest or second highest or something reserves of US dollars, which they can use to basically defend their currency. Now, coming back to this, the Fed manages monetary policy to control inflation, the stability and size of the US economy, and the dollar's global status as the primary reserve currency and safe haven asset. Right? So when there's demand for the dollar, it can reinforce its value through its cycle of global trust, right? So, before all this, let's like go through, or let's think about why we need, what's the point of money, right? And I'm actually like explaining this so that I can understand it myself, because I have fragmented thoughts of how these things work, but I'm not like 100% sure if I understand it fully. So I just want to explain it in words to see if I fully understand it. What is this? Can I use my password? I don't know. What? What is this? Whatever. Can I use something else? Online whiteboard. Yeah, this should work. Start. I'm not using graphic acceleration, so this might be kind of slow, but I think it should be fine. No, I'm good. Okay, so let's close this. Can I make this black? Is there any way to fill more tools? Stop. Shipboard, lasso, point, templates. I don't really care about this. Maybe it's called the whiteboard for that reason. I guess it's okay. Okay, so I mean, let me just go through my explanation. My view for what money is, right? So you have, I guess I can type it because that's probably easier. So let's just put sticky notes. Okay, so you have goods and services, right? And the goods and services in a country can grow by like 2% or I don't know, like it could grow by some number, right? So if the goods and services or the value of goods and services, meaning the productivity and like whatever we actually, when we say increasing the pie, the slice of the pie or whatever. So when we do that, essentially in a perfect system, the money would follow that 2%, right? And when I say 2%, I'm not talking 2% inflation on our money. 2% inflation means that we're not tracking goods and services properly, right? We're giving a little buffer. But the idea is money should represent. I can't type. Money should be tied to goods and services. But the problem is it's usually not, right? So let's just say the government decides to uh, decrease interest rates, right? What that essentially means is the government is lending money at lower interest rates, and that means that they're fiscally uh, sort of expanding money supply, right? And they're giving access to uh, lower sort of interest rate capital, so it's like easier to get money into the TLDR increases money supply, right? But even though it increases money supply, it does not increase the goods and services, right? So it disproportionately affects people who are closer to the printer, essentially. So let's just say you're like a bank, right? And then there's like the Fed. The Fed decreases interest rates. It provides that money first to the banks. Now, to be fair, the bank's fiduciary responsibility is to lend money out. So the first people, the first borrowers, have create something are the people who are inflating the value. So let's just say you have easy example, right? Let's just say everyone has $5 and there's like 5 apples, right? That means I don't know. You probably give each apple $1 of value, right? Now let's just say the Fed decreases interest rates, and I, being the first person, I go borrow $10 billion from the banks at lower interest rates, at like 1% interest rates. Right now I have $10 billion. Now I could buy up all those apples, right? And what happens? The apple seller is gonna realize that wow, okay, there's a lot of demand for this apple because a lot of people are buying it. A lot of people being me, just me, right? But I'm buying it in so much bulk, so he wants to sell it to me. So he wants to increase prices because the number of apples remains the same. So once I start buying 3 apples, right, back to back to back, he realizes that wow, the supply is like diminishing pretty fast. I'm going to increase the price on the remaining 2 apples. Okay, I'm going to increase the supply or the price of those remaining 2 apples. Now, guess what? I bought those apples before the prices were increased because I was the first borrower, right? So I did 2 things. I stimulated the economy, but by buying these apples, right? And those because the money which I used to buy those apples now goes to the guy who sold the apples. Now the guy who sells it buys other stuff. Now I'm stimulating the economy, but I also did something called I think it's called the Cantillon effect, I believe. Right, right. So yeah, so the Cantillon effect is because I'm the first borrower. I do something called the Cantillon effect because I was the first person who got access to the newly created money. I essentially created inflation. I disproportionately caused inflation because now, let's just say the prices of a good is like $1, right? I go buy it up because I just got new money, and then the price of that good increases to $2, right? Now we're talking about an apple, which is it's not an asset, right? It's a commodity. It's sort of it's not a liability, but it's a commodity, right? What if I instead of buying apples, what if I bought assets, right? Let's just say I started buying assets. Like let's just say I bought a house, right? So let's just say I buy a house, and now when I buy up a house, let's just say the house is valued at 1 million. Because I buy up a bunch of houses with new money, I'm inflating the value of these houses. All houses go up because now people have more money in the economy. But guess what? I bought these houses before inflation became a thing. So I disproportionately uh, sort of created inflation, right? So I'm benefiting off of this because guess what? I'm rich. So this is kind of like the rich get richer thing. Whatever. So this is like Canadian economics. People know this. People understand this. Like the people at the Fed understand this very well, right? This is, um, but the way they think about it is this is a lesser of two evils kind of scenario. Because guess what? If you don't introduce new money into the money supply, the people who are really gonna hurt are poorer people, are people with no jobs who are unemployed and stuff. So you have to decrease interest rates and stuff like that to stimulate the economy, so that people who are quote unquote like suffering because of unemployment and whatever things, they basically if they want to get jobs, you need to give capital, or like you need to increase the money supply for businesses to hire more people. So that's the kind of basic idea, right? This is how currency works. Um, so with my kind of coin, what I want to do, I mean, this is kind of idealistic, but like, let me close this by the way. It's kind of idealistic. I don't really care about any of this. So screw all this. I'm not trying to become the Fed. I'm not trying to do all that, right? Usually with a currency, people would think about Canadian economics. I don't really care about Canadian economics. Like screw that, right? What the only goal that I have for this currency, if I can move. By the way, this I don't know if I can actually create this. Like I don't know if I'm skilled enough and stuff. So like I'm trying, but this is the vision. All right, this is the vision, and one can dream. But where's my mouse? How do I move? Oh, I just moved it. Cool. So what I want to do is basically make money stable. When I say stable, what do I mean by stable? I mean price stable. Okay, so what does price stable mean? When I say price stable, um, I don't want 2% inflation. I don't want 2% deflation. I want 0% inflation or deflation. Idealistically, of course. Or I guess 0% inflation. So how would this look? What does this mean? Right? What this means is the money or the coin or whatever I create has to perfectly track goods and services in the economy that uses that money or that uses that currency. So obviously, when we talk about the dollar, I mean, I guess dollar is like a reserve currency. So let's just say we use the yen, the Japanese yen, or something, right? The Japanese yen, you only talk about the goods and services that use the Japanese yen. You don't talk about American. Again, economics is a little bit more complicated and stuff like that, but like in general, you want to talk about the goods and services that are basically using your money to transact. right? So yeah. So what I want to create a coin like Bitcoin or something that essentially is price stable, which means it has 0% inflation. So let's just say it's um, I mean, right now what I named this is it's like dots, right? Like for dollar and stuff like dollar, it's like dots or whatever. So let's just say I wanna keep the price same essentially, so 0% inflation. But what does that mean? So essentially, what I'm trying to do is if let's just say in 1 year, goods and services increase by 2%. By the way, I'm talking to myself, trying to understand if this makes any sense. So you guys need to explain this to me. I mean, if anybody's in the chat, which I don't think anybody is, but let's actually see. I don't think anybody's here, but I don't know. Just one person watching, but it always says that. Anyways, goods and services increase by 2%, right? What happens then is we want to increase the supply of this coin by 2%. Increase supply of coin by 2%. Again, I'm just like kind of thinking about this, thinking through this. I'm not sure if this can actually work, but yeah. So increase the supply of the coin by 2%. Now, what happens if goods and services increase by 2%? We increase the supply of this coin automatically by 2%, which means we perfectly match goods and services continuously, which means that there should be no inflation. There should be 0% inflation, theoretically, right? Now, this is a great question. How do we do this, right? Can we automate this? Like, can we write some code and just say somehow track goods and services and then increase or decrease the supply of your coin? And this is possible, right? You would be like, okay, if you think, let's just say you're tracking CPI or not CPI, what am I? Yeah, like CPI or unemployment or some metric that basically tells you how much goods and services have increased, like GDP or whatever, and you automatically burn or mint new coins. The the blockchain just does that automatically, right? You burn or mint coins like through a smart contract or whatever. By the way, I don't know any of these things. I'm like new to the crypto space. I'm not trying to go into this like NFT crypto bro kind of thing. I'm just interested in the programming and just like lower level concepts. So yeah, I'm not too familiar with anything. I don't hold crypto or whatever. But anyways, um, yeah. So you want to burn or mint coins automatically based on the goods and services increase, right? Now, I think some other people tried this through automated sort of systems, and I think there was one called Terra USD. Um, was an algorithmic stablecoin on the Terra blockchain designed to maintain $1 peg using its sister token Luna through an arbitrage mechanism that would mint burn tokens to balance supply. In May 2022, USD lost PEG, triggering a massive debt spiral where Luna hyperinflation made BUD tokens virtually worthless, causing billions in losses and impacting broader crypto. USD's value is supposed to stay $1 by allowing users to swap $1 of UST for $1 worth of Luna and vice versa, creating arbitrage incentives, leading to panic selling, hyperinflation. Jump Trading did this? Wow, that's so funny. Okay. That's interesting. So now I need to like search some stuff up. Let's touch on that. For Terra. Was not backed by centralized. Programmatic sister token Luna maintained the peg. The protocol allowed users to always swap. Okay, I don't really understand how this works exactly. So they have a sister token, and then they have like a price arbitrage between the sister token. Users always allowed to swap one USD for $1 worth of Luna. So what's this Luna thing? Um, companion coin to the stable coin. Think of it like a pair. One was stable USD, the other was a volatile one, the moon. Okay. Its primary function is absorb price shocks of the stablecoin. If USD fell below $1, the system would let people swap the cheap UST for Luna worth $1. This removed USD from the market, shrinking its supply and pushing its price back up. Luna was designed to take on the risk and volatility so USD could stay stable. That's interesting. The idea is interesting in theory. Luna holders could vote on important changes and decisions for the Terra blockchain network. Luna was staked to secure the network and validate transactions. The value of USD crashed because can you explain what the crash happened in detail? Reflects the relationship. Okay. A large number of users suddenly sold USD, causing its price to drop. Okay. Traders rushed to use the arbitrage. They burned their cheap USD to mint. Okay. Because the price of USD was low, the algorithm had to mint twice as much Luna to value to equal $1 in value. Inflationary flood of new Luna tokens. Okay. 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 That's interesting. Okay, that's interesting. So they basically had a sister coin, Luna, which essentially was like absorbing the volatility, while Terra is like price stable, and the way it works is arbitrage. So I guess that makes sense in theory, but like, okay, so here's my question. $6.5 trillion. Okay, I see. So I mean, what I create might also kind of be something like this. But okay, let me get to the general idea, and then we can go deep into the deep end with like understanding how that works. Okay, so how do we figure out how much goods and services increase by? Right? What if we? And this is speculation. What if we used prediction markets? Okay, what if we have an on-chain prediction market that basically allows traders to predict how much should the supply of the currency be to keep it stable. So let's just say this is the market. How much should the supply of the currency be to keep it stable? Okay. Then traders make a prediction and they use their money to predict. They use their tokens, whatever, they use their whatever they use to make this prediction. And after they make this prediction, we check the results. We check the results on chain automatically. If price was stable, then I don't know. Like the mechanism is a little confusing here. I need to iron these details. If the price was stable, or it kind of like worked or whatever, then they get paid. Else, they lose money. Kind of. So this is kind of what I want to do, and then and I mean that's basically it. So we just have a regular currency like Bitcoin. We have a mechanism to basically increase or decrease the supply of Bitcoin. So Bitcoin has a fixed supply, like I don't know, it's like 20 million, whatever. It's some number of Bitcoins, right? It's fixed. What if in our thing, it's the only difference is that you have like a mechanism to basically increase or decrease the supply of our token automatically, or not token, like our currency automatically. And that increase or decrease of supply is determined by the prediction market. And the prediction market basically, the prediction market, like the traders in these markets have an incentive to correctly predict the supply of that coin that's needed to keep it stable. Now, what do I mean by that? The prediction of like how much the supply should be has to come from goods and services, because this is the only way to know if the price is going to be stable, right? It has to come from goods and services, and one more thing, it has to come from goods and services and potential demand or lack of in the currency. So these are the two things that are in this kind of system. The two things that it depends on is the goods and services. So how much output is increased by for the people using this currency and generating goods and services. So let's just say, so we only care about where this currency is used as a like for the goods and services. Not so it's not tracking the U.S. economy. It's not tracking everything. It's only tracking the market in which this currency is used, right? So the people who are in these prediction markets have to predict the goods and service increase for whatever time period, and they have to predict the potential demand for the currency. So for example, let's just say there's a lot of demand. That means that the currency should be, the supply should increase to fulfill that new demand. And if there's no demand, or if there's people are trying to sell, then it should basically like automatically adjust its supply so that it keeps stable. Now I don't know if this all makes sense. It might actually not make any sense. Like it makes sense in my head, but I don't know. Like I'm not like an economist, right? I'm like a computer programmer, so I have no idea. Like from an economic perspective, I don't know if this is like bulletproof or whatever. So I'm kind of curious if anyone like actually who knows about economics, what they think of this. But like I think it's quite interesting, because I think prediction markets are relatively, especially if there's no incentive for like fraud. Now, obviously, there could be market manipulation early on if there's like no liquidity in these markets, because like in the early days, like let's just say you have only some liquidity, so like obviously some guy, some whale could just flood the market with predictions or whatever. So yeah, that's a possibility. But I feel like when the market has when if it potentially reaches the level of liquidity that you have in like Bitcoin or something, then you have this huge market that's gonna price things correctly, right? So $1 billion buy or sell in these prediction markets, they're not gonna move the market at all. So that's the kind of vision, and you can use this to transact. Like it's going to be minimal. Like obviously there's going to be some volatility, right? Price increase may go 1%, 2% or whatever, but you want to maintain a flat number. Um, yeah, yeah, that's basically it's basically it. But like like the more I think about it, there's some things that kind of don't make much sense to me. Like, how do we value the dollar? We value the dollar sort of through understanding the money supply. Um, yeah, I mean, technically, like if the dollar, if you want 0% inflation, the dollar should be perfectly tracking goods and services, right? Okay, so let's ask Gemini, right? Or about let's see. I'm pretty sure this is kind of how it works. Domestic stability, purchasing power, right, right, right. So there's two different things. Okay, purchasing power is the value of dollar in terms of how much you can buy. This is tracked by inflation, consumer price. Yeah, yeah, yeah. If for the US to be perfectly stable domestically, the annual change in the CPI would have to be zero, or a stable low target. If the CPI rises, the dollar value has fallen. Supply and demand for goods and services within the US, domestic production. Okay. External stability, exchange rate value, tracking other currencies. This is typically measured by US dollar index. Tracks, yeah, basket of major foreign currencies. For the US to be perfect, the DXY value. If US rates higher than Europe, foreign investors move their money, increase in demand during global crisis. Okay. Is the main body attempting to manage both sides of the stability through managing supply and the cost of money. The Fed influences money supply through actions like quantitative easing or quantitative tightening. An increase in supply, all else equal, lowers the value of the dollar, contributing to inflation, potentially weakening the DXY. Cost. The Fed sets a federal funds rate target. When the Fed raises interest rates, it makes the dollar more expensive to borrow and more attractive to save. This tends to strengthen the DXY, attracting foreign capital, but fights inflation. A policy that makes the dollar stronger internationally, higher interest rates leading to higher DXY, can make US goods more expensive to foreign buyers, hurting US exports, hurting its reserves. Perfect purchasing power and zero volatility. Um, well, it's theoretically okay. Fixed exchange rate. The currency value is okay. A central bank, like the Fed, can freely adjust interest rates and money supply to manage its domestic economy. inflation. Fixed exchange rate, perfect. Okay. Um, and I see. This is the idea of a stable coin, right? So I guess you could only do one. Um, I guess we don't care about the exchange rate, to be fair. I really don't care about the exchange rate. Bunch of people use on the internet to do, I can type, to do transactions. This is our economy. Um, Online crypto economy where currency is used for transaction management and then stability is matching purchasing power within that closed system. Can a cryptocurrency achieve a perfect price stability against real goods and services exchanged in their own ecosystem? Yes, it's possible. The key possibility lies in having accurate and continuous information. To achieve this, the cryptocurrency would be an algorithmic stablecoin that is pegged not to the US but its custom price index. The first step is to define the economy as the goods and services bought and sold using CryptoX. The protocol would track the average price of everything sold in the ecosystem, the bundle of services. The CryptoX must always equal the value of that basket. If today the basket costs $100, then X equals 100. If tomorrow the basket costs 100, then X must adjust its value to maintain the same purchasing power, and the protocol must shrink the supply so that existing tokens are more valuable. What is this? What the heck is this? Okay. We need a decentralized Oracle network to constantly feed the prices of all goods and services sold in your online economy back into a smart contract. If a large vendor raises the price of its popular service from 50 to 60, the Oracle must immediately tell the contract that the overall inflation in the custom CPI is rising. Based on this real-time data, a smart contract would instantly and automatically adjust the supply to keep its purchasing power stable. Data accuracy and how do you guarantee that all sellers in your online are reporting their prices truthfully to the Oracle? If people can manipulate the data, they can game the stability mechanism. That's true. The system must adjust supply faster than people can act on the price change. If news of a price change leaks, traders could rush to mint or burn the stablecoin before the system finishes its adjustment, leading to the same kind of instability that affected Terra. For the stability mechanism, the crypto needs to be huge deep market. In a panic, any volatility in the custom index could cause a bank run when everyone rushes to sell the crypto, overwhelming the supply adjustment algorithm. Okay. Through some sort of prediction market. Concept is a variation of a mechanism that uses governance and market psychology to manage stability of an entity. Okay. In this model, the stability of a crypto is not automatically adjusted by a rigid formula or external, but collective profit-driven decisions of speculators in the internal market. The community defines what stable means. Let's say X should be worth exactly 1 USD, or 1 unit of digital service basket. The prediction market. At the end of the epoch, every 24 hours, the prediction market is created. What is the percentage change in the supply of X that is required to bring its price back exactly 1 by the start of the next epoch? If X is trading at 0.95, the market needs to predict the supply reduction. Traders will bet on necessary percentage. Traders are incentivized by a profit. If they predict the future supply adjustment correctly, they earn a reward. Their self-interest drives them. Okay. The consensus prediction is accepted as the final binding order. Smart contract automatically executes the statement. It burns or mints the prediction. A predicted percentage as its total supply. You leverage the wisdom of the crowd. Traders are financially rewarded and decentralized. Challenges. The predictions are based on current data but executed later. If a huge sudden crisis occurs after the prediction market closes, the adjustment could be immediately wrong, causing instability. Okay. If the voting power is highly concentrated, a whale could bribe or manipulate the market to vote for an outcome that benefits the larger holdings. That's possible. The mechanism doesn't eliminate the fundamental risk seen in Terra. If the market panics, the price drops severely. Traders might simply stop participating, and they might predict an adjustment that is too small. If the market loses faith in the system's ability to save itself, the prediction mechanism will fail to function, leading to a crash. Okay. Yeah, these two are definitely problems. I'm just thinking, like, if let's just say we have a huge liquid supply, assuming manipulation and bribing is going to go down, like you're not going to have trillions of dollars, basically. Um, yeah, and the death spiral. This is possible, certainly, but I mean, if your epoch is really small, so let's just say you continuously adjust every second or something along those lines. Yeah. Um, your idea is a form of DAO, applied stability. While no major sale uses a prediction tool, market-driven governance. Okay. The biggest risk will answer the prediction I made through in a panic. The necessary burn rate would be huge. A rational trader knows the system is collapsing. Their priority is to getting out. They will not buy the prediction market if they think the price of the governance token, that one that pays that, will drop to zero before they get paid. I see. That is a great point. Collateral buffer. Okay. And the um I want to like kind of iron out all the ideas before I start working on it. So yeah, the trader's dilemma. UST drops. Mint only Luna. Okay. Interesting. UST drops. I'm not really interested in this idea. The massive burn mid operation is required in terms of doing dynamic escalating exit tax. Wait, what? You just why can't you just stop them from selling, bro? Like what is this? Dynamic escalating exit tax on stable coin sellers that increases steeply as the peg deviates. You pay them in a future dated bond. When a trader buys and burns cheap X, they don't get governance token, they get that bond, future dated token that is redeemable for the governance token plus a huge bonus at a later date. Okay. Again, this is getting more and more complex. It shouldn't be this hard. Like Bitcoin, I understand Bitcoin is complex in like execution, but in terms of the basic idea, it's quite simple. It's a cryptocurrency, you have a blockchain, decentralized, none. Like it's like the networking concepts and like the cryptography is a little complicated, but like it shouldn't have. I guess they have like a mempool and stuff. I guess it's a little complicated, but like, is there no elegant solution to this? Like, okay. The This is so complicated, bro. Okay, let's. I don't think AI is gonna give me a good solution. Like, I'm trying to think if there's any other. Basically, I get what it's saying. It's a pretty good point. The problem is, right, when there's a price, when there is a crash, and these people get paid in the currency that is crashing, they just want to get out, not be predicting. I know. So this is a great point, because when there's like a, let's just say your thing is valued as like 1, and then it goes to 0.5, right? Now the price is falling. Prediction market people, some of them may be like, okay, maybe we'll go back up. So they start predicting. But like most people are not going to be predicting at that time. They're going to be like, yo, this thing is crashing. I want to get my money out. Right? So the problem with the prediction market is if you predict right, you get paid in the same token that's crashing. So if you get paid in the same token that's crashing, well, you're basically screwed because like the price of that, the value of that token is falling. So your money's worthless, right? Every time, okay, what is this even saying? I don't get it. So we have a stable coin and a share token. Every time X is above 1, when demand is high, the protocol mints a small amount of new X. The excess X is immediately converted into the S token and placed into a stability reward pool. This pool is a prize for correct prediction. Your market runs every epoch, asking what percentage change of X is needed to hit 1? This is the core fix, okay? Future stability dividend. What the heck is this? Is a smart contract instrument that entitles a holder to a fixed percentage of the first N units of S tokens. Again, this is like so complicated, bro. Like, what? Uh, if they can buy X as and burn it to get a massive amount of S tokens, is a high priority claim. I mean, this is the kind of the same thing. I mean, they're still the same problem because, like, let's just say this is falling a lot, and you're using tokens to predict, but then like, since you're getting it right, you're basically converting. Like, let's just say it's dropping, so you want to like decrease supply, but then if you decrease supply, then how do you get seigniorage or whatever? Again, this is too complicated. Like, um, Hence a massive negative rebase. What is this? The vouchers are zero coupon bonds. They don't pay interest, just the face value. When the protocol has a surplus. What if the protocol never has a surplus? Like, what do you mean surplus? I thought you're trying to. I thought you're trying to keep stability. You're never. What if you never have a 150% surplus? Like what? I don't think they even do fixes. Like I think real world currencies are like kind of they have a problem with this. Oh, I need to connect this. 1 second. Oh. I haven't done any coding. I've just been like, I call this a programming stream, but it was literally just saying, thinking of an idea phase, if anything. Because I feel like I mean, it has potential if I could really see how to make it work. Like, I should probably just start writing it instead of just like thinking in the clouds. Just like write the basics and see if I could get more ideas and stuff. I think that's like a good plan for next time I start streaming. I'll have to change the name of this stream to just ideating or something. Manifesting dot. Am I still streaming, by the way? Seems to be. Make Crystal Islands. Bidding process. Base is cash. The primary lever. So I mean, like theoretically, using your just have failed because the peg broke. Yeah, they will ever generate future revenue to redeem the outstanding debt vouchers. So I mean, like, I guess I understand what it's saying. It's basically, yeah, there's no like final backing. You don't have like a military or something to like have value and back this currency. I understand that. I mean, that was always the sort of criticism for like Bitcoin and stuff. Um, oh, in our case, I feel like, yeah, that still remains to be the case. Huh? Let's think. Hmm. What is this? Recurring bounty payment. Funds the bounty. Wait, what? Why do we need a bounty? What is this bounty? What? Wait, why do we need a bounty? Uh, is it business? The only. bounty fee. This is kind of interesting though. Uh, this is a little interesting. Like the bounty fix. I guess it's sort of interesting, but like, why do we need a bounty? I thought predictions or something. I guess like what are we predicting? What will the final required percentage change in total supply of X needed to drive that price of X back to at that resolution time? This is not a flaw. This is what prediction markets are good at. Okay, so I see. Okay, so for the what is it? What the heck? Yeah, I mean this should work. That's interesting. What's the price? Wow, it's really stable, huh? Whoa, whoa, whoa. Oh, that's still pretty stable. The peak was 104, and then at the bottom it was 9. How long has this been on for? Since 2019. That's pretty impressive, huh? It's been extremely, extremely stable. That's interesting. Brax. Okay. So it is collateral backed as well. I see. So I don't really care about that. I'm impressed with die or whatever this is. What about Ampleforth? I think this is purely like algorithmic, right? $2, 0.4. Not bad. Okay, I want to ask about how those work as well. Okay. So they have a crypto collateral, but how does that like work? I think I get the basic idea. Next